Welcome to video number 9, T Account Basics. Let's look at our roadmap. Here we are, we're making our way through the accounting crash course. We're on video 9. Previously, we talked about transaction analysis and journal entries. Now, all we're going to talk about is how our journal entries reflected in the accounts that we observe on the balance sheet and income statement. Well, we track those journal entries in T accounts. That's the point of this video. T accounts. T accounts are how we track the account balances. Remember, accounts are what appear on the balance sheet and income statement. How do we track those accounts? Well, we use T accounts, to track the account balances. So these T accounts, journal entries are posted to the T accounts. And when you post a journal entry to the T account, it affects the balance of that account. T accounts actually look like a T, so they've got two sides to them. T accounts have a normal side. Each account has its own normal side. And that normal side is defined by what makes the account increase. So the normal side is the increase side. For assets and expense accounts, the normal side of the T account will be the debit side. For liabilities, equity, and revenues, the normal side of the account will be the credit side. This is what a T account looks like. It looks like a T. Let me draw the T. That's the T. It's how we keep track of whatever account this is, account name, in whatever category it is, we keep track of the account balance in a T. The T account has a beginning balance typically at the top of it, and that beginning balance will be on the normal side usually. And so the account that I'm using in this example, its normal side is the debit side. So it's got a beginning balance in that account. You can think of that as the beginning balance of the year, or maybe last year's ending balance is this year's beginning balance. Then during the year, journal entries occur which affect that account balance. So this one journal entry increased the account balance, and this other journal entry decreased the account balance. Or rather, this one journal entry was a debit to the account, and this other journal entry was a credit to the account. And so the journal entries affect the account balances, meaning it started with a balance of A, and it's going to end with an ending balance, which is equal to its beginning balance A, plus entries to the same side of the account. So A was a debit, B is a debit, so B is going to add to A. C is a credit, so C is going to subtract from A and B. And so that's how you compute the ending balance. This is just the algebra, and we're going to practice this in the next slide. Suppose we have some random T account. It has a beginning balance of 10 in the debit side. Then we recorded a journal entry which was a debit to that account of 5, and another journal entry which was a credit to that account of 3. You could even think of this as a cash account. We had $10 of cash to begin with. We increased cash by 5 and decreased cash by 3. And so the ending balance of our cash account would be 12, right? You take the debits, the normal side, 10 plus 5 is 15, and you subtract the credits, which is 3. 15 minus 3 is 12. We could also have an account that has a beginning balance on the credit side. How does that work? Well, for that, we'll just take the credits, which is 12, and subtract the debits, which is 7, and we'll end up with a remaining credit balance of 5. Okay? 12 minus 7. Now, it's also possible, but pretty rare, for an account to switch sides. So in this account, we had a beginning balance which was a credit, but then we had a strange occurrence, which was that we posted a large debit to the account and just a small additional credit to the account. And in this case, the account will flip sides, okay? So this $10 debit plus $2, we're up to $12, sorry, this $10 credit plus $2 of credit, now we're up to $12 of credit. Well, we're going to debit that account by 15, so it's going to become a minus 3, but we don't do negative numbers in journal entries and T accounts. We just move the side, and now this is a debit balance of 3, okay? So just you sum up the total credits, subtract the total debits, and this account has switched from being a credit balance to a debit balance. And that's how T account math works. So for example, let's just do an example here. Let's post this journal entry to a T account. So this journal entry reflects a sale to a customer on account. So we earned $1,000 of revenue, but we haven't collected it yet. So we're just going to put it in the list of people who owe us money. Here's the accounts receivable and revenue accounts, okay? So accounts receivable, I've made up an opening balance of 500. Revenue, suppose we're at the beginning of the year, so I've zeroed that account out. We've got no revenue so far this year. Now, what I'm about to do is I'm going to post this journal entry. This is the word post. I'm going to post the journal entry to the T accounts. And here's how I do it. So this debit to the accounts receivable account just gets placed in the debit column of accounts receivable. The credit to the revenue account gets placed in the credit side of the revenue account. And now I can just sum up these accounts and come up with their new balances. So accounts receivable started with a $500 balance, it increased by $1,000, and now $1,500 is owed to us by our customers. On the income statement, we'll observe revenue of $1,000 so far. Okay, that's how we post journal entries to the T accounts. And that's it for the basics of T accounts. Pretty simple. It's just tracking all of the journal entries that we're recording. In the next video, we'll go through our exercise again. We'll take those journal entries and we'll post them to the T accounts of our basic generic inventory company.